Hello, I'd like to talk to you about the excess burden of income taxation. I wrote the equation up there. DWL stands for dead weight loss. It's a welfare cost. It's an excess burden of the tax, and this specifically is for income tax. So let's talk about what the different things are standing for up there. Let's see if I can get my pen over here. And let's do... Okay, dead weight loss is a triangle. And in fact, let's show you what we're talking about here. Oops, that doesn't look very good. Oh, that looks not bad. And let's say this is my supply curve, compensated supply curve. Here's my labor, quantity of labor, wage rate. And let's actually use some numbers to explain this. Let's assume my elasticity, compensated labor supply elasticity, so this epsilon looking thing, my Greek letter, stands for the compensated labor supply elasticity. I'm going to assume that's 0.3. Let's assume this W is my wage rate. I'm going to assume my wage rate is equal to 10. That's kind of an easy number to work with. L is labor. I'm going to assume that's equal to 100 million hours. T is my tax rate, my income tax rate. T I'm going to assume is 0.5. So what we have here is, let's draw some of these numbers in. So here's 10, let's make it a little prettier. $10 an hour, $100 million. Now, if the government takes 50%, it sounds like a story problem in school. If the government takes 50% and you get to keep the rest, how much do you get to keep of the wage? Well, if the wage is $10 an hour, 50% goes to the government. Well, what's left is 50%, so half of 10, I think, is really close to 5, don't you? Then the question, story problem, keeps on going on. Well, if you get 100 million hours, but people reduce their labor supply by 30% of the change in the wage. In other words, the elasticity is percentage change in labor over the percentage change in the wage rate. That's going to be equal to 0.3. Well, what was our percentage change in labor? Well, we had a 50% tax, so we just put in that tax. We have a 50% change in the wage rate. We got to keep 10 before. Now we get to keep 5. So that's a pretty big change. So if I'm solving for the numerator, remember story problems that you did on previously? If you're trying to solve for the numerator and you have the denominator and that's equal to some other number, can I just multiply both sides by 0.5? 0.5 times 0.3, I think. So my percentage change in labor is equal to 0.5 times 0.3, which I think is pretty close to 0.15, don't you? So in other words, I take the original 100 and I have, approximately 15% reduction in labor supply because I work less, I assume, if I get to keep less money. So really this case is a negative 3. This wage goes up. I reduce my labor supply. I'm just taking the absolute value up there. So I could write it a couple of ways. 1 minus 0.15, which would be 100 million minus 15% of 100 million. So 100 million is for the 1. 15% reduction is right there. So in other words, it's going to be 85% of 100 million, which sounds pretty close to 85. So why don't we just write 85 over here? Okay, we now can find this triangle. Well, the triangle, the area below the supply curve is the value, is my opportunity cost. Well, I'm not working these, 15 million these hours, so I have a reduction in labor. We value that time not working. This area is some of that producer surplus that is just gone. It's a dead weight loss, this triangle. This rectangle that we're going to be talking about in a little bit is going to be our tax revenue. And this lower rectangle, 5 times 85. I get to keep $5 an hour times 85 million hours. Okay, not just me, but all these other people are working would be our income. So let's calculate our deadweight loss. Our deadweight loss is going to be 1. Actually, let's change colors. Let's make it red. So we have, okay, so I didn't turn it red. Okay, let's try it again. 1/2 0.3 is, so that number right there is 0.3 times the wage is 10 times labor. Okay, so I'm going to say times that times labor is 100 times 0.5 squared. So 1/2 times 0.3 times 10 times 100 times the tax rate squared. There's our tax rate 0.5 right there. And I calculated that that is $37.5 million. So this area right here would be our $37.5 million. Well, now let's calculate our tax revenue. So the government would like tax revenue. I'm feeling kind of blue about that. So I'm going to take the $5 tax revenue. So the tax is 50% times the number of hours. So I've got, my number of hours isn't 100 million anymore. I've only got 85 million hours that I'm working now. I can't tax hours I'm taking as leisure time, can I? So it's going to be 5 times 85. And I calculate 5 times 85 is about 425. So this area right here is my revenue. Tax revenue. Okay, well, what about this area down here? I'd like some green money. If it's American dollars, I like to see them, especially if they're mine. So that area down there is going to be, well, it's going to be 1 minus 0.5. I get to keep half of it, times the $10, times 85 million hours. Okay, some of you are thinking, why didn't you just, you already told us it's $5. So, in other words, 1 minus 0.5 is 50% of 10 is $5 times the 85 million hours worked. And so that's pretty close. Well, it's pretty much the same number as up there, 425. So this, half of my money goes to the government, half of it goes to me. So I'm assuming kind of a fixed a tax that doesn't change, 50% marginal tax rate, which is kind of a high marginal tax rate, and so all my income is taxed at that amount. So the government gets their $425 million. So a few simplifying assumptions, but it does show some things that are going on. In later programs, what we'll look at is what happens when the elasticity goes up. Well, if elasticity goes up, I'm going to work less. I'm going to respond more to the wage change. So my deadweight loss is going to be bigger. And the hours worked are going to be smaller, so the revenue is probably going to be smaller. What happens when the wage rate changes? Well, if I got more than $10 an hour, well, then I'm going to have a bigger, that's going to be up here further. So I could have bigger deadweight losses. Likewise, labor. Tax rate's going to have a big effect. Higher the tax rate, especially since tax squared. So I just, notice it goes, as I increase my tax rate, the deadweight loss goes up by the square of that term. That, in other words, lower taxes mean, especially low broad-based taxes, are going to tend to mean lower deadweight losses, because if I have more broad-based taxes, normally I can have a lower marginal tax rate. And so our cost of raising tax funds will be lower. Well, I hope you enjoyed the wonderful world of excess burden of income tax. We'll talk to you later. Thanks.